Retail traders worldwide are turning to ETFs to get access to what they want the most. That's U.S. tech stocks. I'm talking NVIDIA, Palantir, Coinbase, Tesla, MicroStrategy. Since the SEC approved the first single stock ETFs in the U.S. in July 2022, this category has exploded. There's now 60 single stock ETFs trading in the U.S. with combined assets under management of $18 billion. Most of them are long versions that trade with 2 times leverage. Let's talk with Will Rind. He's the founder and CEO of Granite Shares, who runs the largest single suite of single stock ETFs. Ben Johnson, head of client solutions at Morningstar, joins us as well. Will, your NVIDIA 2 times long NVIDIA ETF, single stock ETF, it's the leader. You've got $6 billion in assets under management. I'm always curious, given the short-term nature of these, who owns them and what are they doing with them? Explain to us.
Yeah, so in terms of the ownership, what we've found is actually it's something of a worldwide phenomenon that you've got investors, not just here in the United States, but around the world. And in terms of those investors, that's everybody from retail investors all the way through to your most sophisticated hedge funds and proprietary trading firms in the world.
Yeah, so most of these investors, we've covered this and Ben's covered this for years. Most investors last year, they put money into plain vanilla index ETFs. That's where most of the money goes. But there's this increasingly retail component out there that wants to trade volatile tech stocks despite the fees and the risks that are out there. You've called this retailization of it, but it's fascinating how there's a global component to this. Explain what's going on.
That's right. So another word for retailization is self-directed. And this is about more and more people taking charge of their own finances. Now, as you rightly point out, that's not going to be necessarily for the bulk of their portfolio, but increasingly that's for a smaller amount of portfolio where they feel like they want to have a bit more control, they want to be able to actively manage that and maybe try and outperform. And that's where we see things like leveraged single stocks really playing. And as I said before, I mean, this is something where it's not just the US investor, this is a worldwide phenomenon because we have investors all around the world that are looking to the US ETF market first because that's the biggest source of liquidity, but they're looking to the names that they know and love, the Teslas of the world, the NVIDIAs of the world. They're only available here in the US, and that's why people come here to trade them.
So you have this group of young people that have grown up watching TV in South Korea, in Malaysia, in Japan. Their own markets aren't that vibrant or interesting. Is that your point? And China is difficult to invest in, and there's not a lot of tech stocks in Europe. So they grew up listening to Elon Musk and to NVIDIA and Tesla, and that's what they want. There's a theme here that's very interesting.
Yeah, absolutely. So you got from me 2 things happening. First of all, the domestic equity markets, the domestic stock markets may not have performed as well as
in their
US
countries.
In their countries. So therefore the US is attractive. The second thing is when we think about global technology, Chinese technology is uninvestable now for a lot of people. Europe has no technology really to speak of. It's all here in the United States, and so people increasingly are accessing the US market and US technology stocks in particular from all over the world.
Ben, I want you to weigh in here. There's a lot of big themes here. One is this sort of globalization of trading, but there's 2 big objections that Morningstar and you have written about over the years about these kinds of products, leverage and inverse and single stock. First are the high fees, and Will charges 1% for his products, 1.06%. And the second is the daily reset. So investors holding this more than a day don't necessarily get the leverage or inverse coverage indicated. Tell us, where does Morningstar come down on all this? What's the right way to look at this?
Yeah, Bob, what I would say is, at risk of this reference being lost on a younger, more global audience, in many ways I think of these ETFs as being sort of the George Costanza of the ETF world, and that most investors would learn to do the exact opposite of what they're doing. First and foremost, they're designed to work on a daily horizon. Investors need to think long term. These ETFs offer exposure to a single stock. Investors are generally best served by diversifying broadly. Investors also should probably pass on leverage more often than not. And I think importantly, investors need to be always focused on fees because investing, as we've learned from Jack Bogle, you get what you don't pay for. And what you pay for here is many, many multiples what you can get from a very broadly diversified, unleveraged total market index ETF. Now that said, let's not conflate investing with speculation. And I think what you have here is a tool that's most useful for speculators. And what we see in the data is that these ETFs have generally been used as advertised. If you take Will's own flagship fund, NVDL, for example, my calculation showed that last year, that entire share base turned over once every 5 days. So generally speaking, what we're seeing is that people are using these to take a punt and not necessarily to invest for the long term. If you're doing that with eyes wide open, and when I mean eyes wide open, I mean Clockwork Orange style eyes wide open, and in a way that isn't adversely affecting the bulk of your portfolio, then there's a use case here.
You know, I'm not sure you would disagree with a lot of what he actually says there. I mean, the daily reset and the high fees, you've acknowledged all that, and it hasn't seemed to be a deterrent for people investing in this. Why is that, and what do you have to say about those specific concerns?
Honestly, what Ben has just said is, to me, the exact sort of thing that people should be doing for long-term investing. And that's no different to the way that we see it. As I said, I think the majority of people, the reason why your S&Ps, et cetera, of the world maintain the highest number of inflows is because that is what people are doing. What we can't ignore is that there's an increasingly larger amount of capital going into shorter term investments. These are self-directed. These are people that are looking to manage, you know, some of their play money, whatever you want to call it. And that's where this kicks in. And when you look at the fees charged by, you know, our products, for example, they're incredibly inexpensive for a short-term investor who's comparing it to the equivalent cost of, say, using leverage in a traditional brokerage account. So you always have to compare apples for apples. And from that perspective, you know, as you can see from the trading volumes and the assets, these single stock ETFs like NVDL are incredibly popular.
Right, so your point is that if, first off, the people who are doing this aren't worried about the 1% fee because they're in and out on a daily basis, so it's a minuscule aspect.
Absolutely.
And comparatively, if they wanted to actually reproduce this in a brokerage account using options,
it
somehow,
wouldn't be 1%, it would be 15%.
Yeah,
you know.
much more than that.
Yeah.
You run long-short leverage inverse ETFs for several companies. You have their pairs. You have one for Tesla long-short, Coinbase long-short, AMD long-short. And then I'm showing the assets under management. Here's the Tesla daily long-short here. What's going on is the short ETFs are a fraction of the long ones. And this is true of all the other two that you own here. It's just curious to me why is it because of the momentum? I mean, look, you've got $1 billion in the Coinbase long, and $5 million or so in the short. Yeah. Is this because it's a momentum play, right? The stocks have been going up, so there's not much short. Is it that simple? Look at it here for.
I think it is. I think it is that simple that, you know, we are in a bull market, so naturally we're going to skew even more to the long side. But I think if we wanted to take it back and be a bit more balanced, the market skews long anyway, and shorting just by definition is something that the vast majority of people are not familiar with and don't do. Even the professional advisor manager class don't typically use short instruments or aren't able to go short. So it's actually something that only a very small number of people in our markets use, typically hedge fund managers and other, you know, institutions. So this is providing those kind of tools, but naturally they're not as popular as the long versions, which people are more intuitively familiar with.
And Ben had a point about the turnover in these funds, and you, when we were talking earlier, made a good point to me. You manage 10 billion of the 18 billion, and how much does that turn over on a daily basis?
Roughly a third of it turns over on a daily basis. So if you think about 10 billion, somewhere around $3 billion turns over every day. So it's an incredible amount of trading activity. And again, I think that goes to the shorter term nature of the investors, the traders, the users of these products.
So Ben, weigh in here. I mean, what could go wrong with all this? I mean, you saw the assets under management there. They're all skewed to the long side because, well, you know, these stocks have been up recently. But what's the downside here? What can go wrong with all of this? Be Jack Bogle for us, and as you often are on our shows.
Bob, where there's lurking risks is just in instances where you have, you know, especially retail investors that conflate speculation with investment, that don't adequately understand exactly how these products work, especially that daily resetting of the leverage factor that underpins some of these leverage products. They hold them for longer periods of time, and what they get is not what they would have naively expected. So I think, if anything, if I can look at that as glass half full, maybe they learned some painful lessons along the way, and they come full circle a bit faster than they may have historically, learning from these Costanzas of the ETF world. But generally speaking, as I shared my own data, as Will's validated, what we tend to see, just based on the sheer trading volumes here, is that most of the investors who are using these products are using them in a way that at least seems to show that they know exactly how they work and they know exactly what they're doing. They've read the user's manual for this particular set of chainsaws.
Yeah, that's why I've sort of moderated my dislike for them over the years, because in the early days with the index long and short, we had big problems. I mean, I know viewers had a hard time getting their head around the reset, the daily reset. They couldn't quite get that. But I think investors are getting a little more sophisticated. I'm not in love with these for the exact reason that you said, but I'm particularly alarmed when people do this and think they're going to get a different outcome because they don't understand the product. I think that's a little less likely now as people get more sophisticated about what these things are doing.
Yeah, that's right. I mean, single stocks are new in terms of the category of leveraged single stocks, but leveraged ETFs are not new. I mean, they've been around for 15 years now. We've been through peaks and troughs. We've been through financial crisis, COVID, etc., and these products have delivered, through that period. So I think the point is well made that, like any investment, you have to understand how the product works and the associated risks involved. But this is not something that is new. This is a new category within the leveraged ETF business. And of course, when people look at, for example, a advantage of having a product that has no margin calls, is able to deliver 2 times leverage, if that's the leverage factor every day, that is the pro to some of these cons.
And I don't want to get too deep in the weeds, but give us 30 seconds on how you actually accomplish this 2 times long. What kind of derivatives are you using to actually make this magic work?
So it's typically a derivative contract known as a swap, which is a type of derivative that effectively provides that leverage, provides that funding to the ETF to enable it to try and achieve its daily investment objective, which is 2 times leverage.
Right, and your counterparty is charging you a fee to do that is built into this 1.06% that you have.
And those are typically large investment banks, of which people will be familiar with, but that's the way that the funds are achieving their leverage. And again, it's the same for all leveraged ETFs, regardless of whether it's single stocks or whether it's broad in equity indices.
There's a wrinkle on this, another wrinkle. Got a lot of wrinkles here, folks. There are variations on single stock ETFs. There are covered call strategies now that exist. And essentially, folks, if you don't know this, there's basically 2 parts to this. First is the ETF would go long a reference stock like a Tesla, for example. And second, they would sell a call or put option against it, normally near term with something like 1 month expiration. So you're selling the option and it generates income for investors. You just started a product around this recently, NVDY, I believe.
TSYY, that's the brand shows the Yield Boost family, which is our new family of high income generating, high yield generating ETFs. And those are mixing options, like you said, with leveraged
So
ETFs.
Here you own Tesla and you're selling a put here for Tesla?
Selling a put, yeah, but it's on the actual levered Tesla single stock ETFs. So you're selling put options against underlying leveraged Tesla ETFs, and that generates a lot higher.
Oh, that's how you get higher yield.
Higher yields.
Right, now you haven't had a distribution, right, yet?
We haven't had a distribution. We technically had a tiny one for the Treasury income, but first distribution will be sometime this month.
Right, and again, this works great. You theoretically will have a great distribution on it 2 times, selling put options, as long as it keeps going up, right? I mean,
that's right, and we sell out of the money puts. So the idea behind that is to provide some capital protection, meaning that if you're just selling at the money options, then you don't have any capital protection against the downside. And if you look at the performance of TSYY, I know it's only been a few weeks since inception, but you can see against Tesla and some of the other competing products perform very well.
And Ben, the increasing complexity of the whole ETF world, just covering buffered products and JEPI and all of that, and just explaining it to the viewers and the readers, it's getting tougher and tougher. Some of the stuff's getting very complex, and yet there seems to be an appetite for it. How can you explain that other than the ETF industry needs to grow and collect assets under management and higher management fees? That's perfectly understandable, but what's the right way to look at all these new products that are out there?
Yeah, I think there's just generally, and has been for quite some time, Bob, just an appetite for regular income among investors. And in the secular trend, as most of the investors that have most of the money shift from accumulating assets to spending down their assets in retirement, that demand for just regular sources of income, I think, is only going to continue to grow. I think the other secular trend you see at play here is really just a rewrapping of strategies, of tactics, of trades that many investors, many advisors may have done sort of independent or outside the context of a prepackaged single trade solution like an ETF, coming to market in a sort of do it for me package, whereas previously it would be a DIY or do it yourself model. So I think there's two key secular trends there. I think there are also important things that investors need to keep in mind. First and foremost, when they see these very large, double-digit distribution yields that many of these firms publish, it's important to understand where that income is actually coming from and what it is composed of. So in some cases, it's the income coming from selling call options over whatever the portfolio or single security might be. In other cases, it's actually just a return of capital. So investors are kind of paying for the privilege of having their money sent back to them. So understanding the composition of these income streams, their durability, their volatility, and all of the various tax considerations is absolutely essential if you're going to use these well.
Yeah. Well, in this case, you're selling a put, right, on the 2 times NVIDIA.
Yeah, that's right.
And in theory, you're going to have a nice distribution.
Yeah, and we're trying to take advantage of that implied volatility difference. That if you think of the implied volatility, say on Tesla options, say for argument's sake, it's around 70.
Now you're turbocharging it.
Yeah, now you use the leveraged.
And this is how you can get
ETF
20, 30,
option.
40% distributions.
That's right, and then you can.
That sounds fantastic. It's like free money, but what's the downside? Try explaining that to people. Like, oh my God, I'm going to get a 40% distribution on this, or some. Yeah. You haven't done it yet, so I'm making this up.
The downside is just like any other product, that the value of the underlying, in this case, the value of the underlying options will fall or can fall over time according to the price. That's why we sell out of the money, to try and give some protection against that downside. But that's clearly just like any other investment. These things will go up and down.
Yeah. What's next? The race is on to find the next big volatile name, I gather here. Is there anything on the horizon you've seen unusual activity? Palantir? I don't know. I'm making it up. But
I think there's 2 things going on. So one, we'll expand the leveraged single stock universe, because that's where we have a huge amount of demand, and there'll be demand for different names, different sectors, et cetera, over time as market conditions change. We'll also be expanding our yield boost family, so providing access to those really high levels of yield, and that won't just be on single stocks such as Tesla. That will be against other sectors of the market, broad indices, et cetera. I think that's got a lot of potential to be a big family. And then broadly, we've got a new administration coming in. We know that there's going to be some big policy changes on the horizon. Those affect markets, and that will give birth to another set of new ETF ideas.
All right, I'm going to have to leave it there. Fascinating discussion, folks. Start of the new year, start 6th year for ETF Edge, and that does it for this week's ETF Edge. My thanks to Will and to Ben. We've asked Ben to stick around and provide additional perspective on ETF trends in 2025 for the ETF Edge podcast. That's coming up. And remember, you can see all of our shows on the website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.